Vinton,
Witten, happy Friday.
happy Friday, my friend. Hey, guess what? I forgot to do, but hopefully people come along. I forgot to update the title of our live stream. It says, "Will construction price problems last forever?" Well, Alison, hello, Jeff. Oh my God, they're back. What do you do?
We can do this. We can do this on the spot, can't we? We can change this stuff live.
Well, last time I did it, it changed here, but it didn't change actually on the stream. So hopefully everyone's anyway, today's Wealth, Wine and Wisdom, folks, is all about the interest rates. But welcome back, Andy. We were just adding it up. It's been about 2 months. Bob, Jeff, Alison, Jeanette.
Yeah. Welcome back. We're back by unpopular demand.
Welcome back to another Wealth, Wine and Wisdom, folks. Great to have a few of you guys on today. We know we've been a bit MIA. I think we sort of run out of steam, run out of organisation, run out of bandwidth in the last month or two.
It was a big end to the financial year. It is the biggest end to the financial year we have ever had, bar none, ever. Full stop. And mate, it was the good, the bad, the ugly, and some of the absolutely bloody magnificent. Like it had a little bit of everything in it. It really was. It was quite incredible.
Well, it's great to have you guys back with us. Alison, great to see you. Jeff, mate, I know you've been chasing us for a few weeks. Bob, always good to have you on board, mate.
Oh, from Sadler's. Yeah. Sadler's. That's Wendy Loretti from Sadler's Creek Winery. We had a few sponsored episodes by them at one point in time, Jace.
We did. Jules is sending us big kisses. Chucky's on board as well. Great to see you guys. Welcome to the relaunch of Wealth, Wine and Wisdom. What's on the menu for you, mate? I was telling Andy. Well, I think I said this a while ago, folks. I went on a bit of a wine tour.
Listen to this, guys. This is a perler. Witten's stepping up his wine knowledge, and mate, this is a cracker.
I'm trying to get better at the wine stuff. I'm even drinking from a glass. And Andy, I think this is the glass that you bought me, didn't you? Didn't you buy me some glasses? So I thought I better step stuff up. I went to the Barossa Valley, folks, to try and buy some wine. Unfortunately, 2 glasses of wine screamer later, I ended up buying $10,000 worth of wine when I thought I bought $1,000 worth of wine. And I ended up, I don't know how it happened, but I've ended up with something strange and weird called Alicante Boucher, which tastes like a rosé. And Fenton's not even impressed. He's turned his nose up already at me. But anyway,
it's not the wine that I'm turning my nose up at. So let's before we get into it, Witten's gone over and he's literally gone out and he's grabbed some incredible wine from the Barossa Valley, part of the Chairman's Club. Didn't realize he was doing it, but bought himself a wine fridge, stored some real cracker bottles, right? And he's like, I just don't know about this one, Fenton. He's gone, it's a little bit light. It's a little bit like a rosé. Maybe I'm meant to drink it cold. And I'm like, oh man, like really? So the quality has gone up, but it's baby steps. So yeah. We're going to get there.
Thanks, mate. I appreciate your mentoring and coaching. All right.
Please don't call me that.
Well, folks, you guys know the drill. Well, some of you do anyway. If there's anybody new, give us a shout out in the chat. Great to have you guys on board. Bunch of you jumping on right now. Andy and I, Wealth, Wine and Wisdom. We started this a while ago to serve our collective communities. Andy in the small business, small to medium business, now getting into the larger businesses and advice world. Myself in the world of property investing, combining our two knowledges and support for those communities and enjoying a Friday wine and debriefing the week. Started COVID-ish times, continued for a while, been sporadic of late, but it's time to kick off and get back into it.
Yeah.
and make it happen. We've got a few people in the house, which is good. John O'Rowley, good to see you.
The roller's rolling by. Welcome, John.
Rolling by. Fantastic. And I think the theme of this Wealth, Wine and Wisdom, Andy, folks, is about interest rates. It's on the tip of everybody's tongue. So Andy and I have got a few things that we want to go through with you guys today. So make sure you stick around, tag anyone who needs to hear about what's going on, and getting their heads around interest rates. Really, at the end of the day, everyone.
So important. Look, I almost think in some ways, Jace, I think we left everyone alone as the world started to fall apart. Just to see whether what we'd been saying over the last 2 years had landed, and whether everyone was holding their sanity through what could only be what we've already labelled as clickbait journalism at its best. And it is rife right about now. I've got a perler example for you later on. But hopefully all of you guys, after the last couple of years of watching, and for those of you who are new, welcome. But hopefully you've sort of realised that you turn off the channel when these Muppets start talking their clickbait gibberish and start the fear mongering. And you just get on with business, and you start to look for the truth, and you ask, where's the truth in that? And so hopefully you've done that. It wasn't necessarily our intention to do that, but hopefully that's the result. But it has been a big end of the financial year for both of us as well. And hopefully it's been a good one for all of you guys out there. But I'm looking forward to getting stuck into some of the BS that's in and around, and just cutting through the scare mongering and getting down to the brass tacks of what's actually really going on. What's happening with interest rates? Where are they likely to be? What does it all mean, Jace?
How does it flow on? Yep. Should we be running for the hills, Andy, and selling everything and buying a bunker in the hills, or
mate, well, I read The Age the other day, and I started to pour a bloody deep concrete shelter in the back paddock after reading that. Got 4 excavators getting a nice little end of world scenario on the farm ready, based off what I was reading there, mate. Jesus, unbelievable.
There you go. Well, mate, everyone's very happy to see you survive Rona as well. So some shout outs to you for that one.
Thank you, team. Wow. Look, I don't mean to take the mickey too much. It was horrible. It was nasty, the old spicy cough, and I've still got it. I'll try and mute whenever it comes through. And the voice, the dulcet tones aren't quite where they are. They're a little bit more mid than the baritone that I normally am. But I must admit, I sort of had it, and I thought, after having it, because there's this anticipation getting it, and after I sort of came through the journey of the horror that what it was, I kind of thought that is what caused billions of dollars, trillions of dollars to be stimulated and shut down borders. And it's kind of like, I was almost a little bit disappointed. I was like, I actually expected more. I didn't want more. I didn't want more. It was very, very nasty. And I don't mean to undermine, those people who have really suffered from it. But personally, I was expecting to really be broken to bits for multiple weeks. And, luckily enough, I wasn't one of the people who really got it bad. But it did leave me wondering, going, what's this all about? I just thought it would have been more severe, given the fact that it basically stopped the world for 2 years.
Well, mate, we're all glad you got through it. And Jono's what's that one? And Jono's happy that you've flashed up a little bit this afternoon.
Oh, that's it. I knew somebody was going to comment on this. I knew it.
Get it off.
I thought, I can't raise the standards. It's not on brand, is it, Jono?
Yeah, exactly. Oh, well, mate, folks, most of you know the drill when it comes to the show, Wealth, Wine and Wisdom. We drink some wine, hopefully not too much. We get a chance to have a conversation or a bit of feedback, a bit of a chat about what's in the news. What's in the news right now? The last month or so, it's been all about interest rates and the end of the world, which is not going to happen. But, the media doesn't like to report fact. They like to report, fucking hot air and
mass
sunshine.
Fiction. That's what media is at the moment. It's mass fiction.
Well, that's exactly it. When the entertainment is now about true life, and the media or the news is about fiction. Anyway, there you go. So we'll do a bit of what's in the news. We'd love to hear your questions, folks. If you got any questions, whack them in the chat. We haven't been together for a little while, so make sure you let us know what's on your mind. And today, as you can see down the bottom, we've got a bit of a theme for Wealth, Wine and Wisdom today, dedicated to interest rates. Now, I don't know, did I spell FX right, Andy? FX?
Probably I always forget whether it's an A or an E.
Yeah. Anyway, so can someone tell me whether I got it right? And even the there, is it there as in a person or there as in? Anyway, hopefully I spelled it right. But you know what we're trying to say. We need a producer on so we can look a bit sharper, Andy.
Preferably a non-dyslexic one. Yeah.
Well, that's someone who can spell. That'd be cool. And maybe a bit later we might share a few things about things you should know. So great to have you guys on today. And Andy, I know you caught up with someone very smart in your neck of the woods the other day, and you guys talked about a few really highbrow, high-level things, and you were going to bring it today. So I might get you to lead off with your stuff to really start the conversation, folks. Today we're going to dedicate the next 45 minutes to a conversation about interest rates and what they mean potentially to our two communities. And, what we think the future might hold, short-term, long-term, and have we seen it before? So it's kind of where we're at. So make sure you put your questions in the chat, but I'm going to chuck it over to you, brother, and get you to kick off this evening's one. Yeah, let's do it.
And 100%, we haven't been here for a little while. So if there is anybody that you think has been a little bit edgy or a little bit punch drunk from the news or something to that effect, just tag them in. Put their name in there, tag them in so they can come and have a listen to this conversation, whether it's tonight or tomorrow or listening to the podcast. Because this is my theme.
Let's have a look at what's going on. Fenton.
So Andy Fenton's quote, and it's kind of around this. It's who not to trust, right, at the moment. And so let's have a little bit about look at this. And I've got a lot to go into interest rates later on in what you should know, but I just want to have a little bit of a look back over history. We called BS a little while ago on this one, but anyway.
Yeah.
So look at this. This was 3rd of February 2022. RBA hints no rate rises before 2023. Well, they hinted to that, and then they said unequivocally no rate rises until 2024. So people are rightly going in Australia going, well, hang on, what's going on? They literally came out and said no interest rate rises until 2024. So what's changed? It must be so bad for them to take such a polar opposite position. But have a look at this. Lowe admits embarrassing error on 2024 rate rises, which is sitting here. The part I love about this, Jace, listen to this. The Reserve Bank of Australia, Governor Philip Lowe has admitted that the central bank's pandemic guidance that interest rates would not rise until at least 2024 was an embarrassing error and it should have done better. Dr. Lowe said that the internal RBA review of its so-called forward guidance during the pandemic would be conducted and the findings later made this year. But thankfully, we were wrong. Thankfully. Fuck me. Dr. Lowe said, after lifting interest rates on Tuesday from an emergency 0.1% to 0.35% and signalling more rate rises were coming, thankfully, we were wrong. Sorry, mate. I don't concur. I'm not thankful for it whatsoever. And then we have people like parasite's a strong word, isn't it, Dave?
Get in there, Fenton.
It's a strong word, but mate, I'm just so yes. Like I'm going to chat a little bit later on about the RBA's early calls. So I'm leaving this as a bit of an open loop.
Yes,
but this just pissed me off. And like, let's have a big look here, folks. Whenever you see newspaper articles and whenever you see this opinion piece, and this is in the Fin Review, and I did see one of your posts recently, Jason, where you actually grilled someone in the Fin Review saying you Muppets should know better than to print this rubbish, and I liked it and supported it. But, mate, listen to this, and I'm just. This is why, people. This is why you have to fact check everything, because listen to this BS, and it's not even opinion. It's just it's misleading and it's wrong. And Christopher Joyce, you should know better. Like, listen to this: how the RBA duped Aussie households. Martin Place risks destroying economic prosperity with some of the most aggressive rate hikes in the world. Some of the most aggressive rate hikes in the world, Jason. Do you think I've gone and tested whether that's actually true?
Well, you might, Andy, but most people won't, right? So, yeah.
No, I think that this is just creative license to print garbage.
It's another way of saying they were lying or full of shit. But anyway, keep going.
So let's just go to the facts, shall we? Let's just go to the facts. All right. So opinion piece. I'm just going to go not opinion. We'll call it either BS for bullshit or lies. One of the two, like whichever. And I'm not going to call him a lie, but it's just misleading. Check this out. All right. So this is the facts. Let's have a look at the facts. All right. So macro bond. This is from. Thank you very much, team, for putting this together. It wasn't for us, but Jason's head in the way of that. But I just wanted to give them credit for the graph. This is the cash rate of all of the kind of major places in Australia. I'll just give them a little bit of a squeeze a little bit later. There we go.
Out there. There we go.
Yeah, perfect. Thank you, Jace. So check this out. So Joyce, right or wrong? The most aggressive rate cuts in the world. So I would think that if you're going to compare us to the rest of the world, you might compare us to the United Kingdom, maybe the US, maybe even New Zealand, our neighbours across the ditch. Would you think that'd be a fair assumption? Is that
I mean, Andy, I reckon I didn't even go to uni for very long. I went for 1 year and then thought better of it. But what I did know is when I was writing an essay for university, the first thing you do is you put a list of the sources you claim to have read and say, like a fact check. Yeah.
I should go to the bottom of that column, that opinion piece, and check the facts, because maybe I'm looking at the wrong statistics. But mate, fair to say, the United States here would be a good comparison if we're going to make such aggressive comments like the most aggressive rate cuts in the world, right? New Zealand, a good comparison because they're just across the ditch from us. Right. And the United Kingdom, well, we were founded by them, really. So probably a fair comparison.
Be good to check in. Yeah.
So let's have a look. Let's see. Where do you reckon, everybody? Where do you reckon Australia ended up out of the four that are on here? Do you reckon we were the most aggressive, being number one place, the second most aggressive, the third most, or do you think we were actually the least aggressive? I'd love to know your thoughts. Whack it in the chat.
Andy, I think you're giving it away. It's on the chart, isn't it? It looks like we're the least.
Some people may not have looked at it so far. So let's have a look at this. And Jace, you and I spoke about this in a Wealth, Wine and Wisdom a couple of months ago. Right? The most aggressive rate rises actually in some of the Western world, the more aggressive rate rises. Let's just say more aggressive because there's lots of it going on.
Yeah.
Right. So one of the more aggressive maneuvers, and we called it a while back, was New Zealand that rose their rates very much out of line with the rest of the world. They started, they were one of the first. Yeah, Jeanette, go Australia. Go Australia.
Winners.
We're the winners of being the least aggressive. So let's have a look. New Zealand, they were aggressive. They were the most aggressive based on these four. Right. So then we go, okay, well, let's have a look at United Kingdom. They've gone through a little bit more pain than us. Right. They were reasonably aggressive, right? Reasonably aggressive in comparison to New Zealand that went early and went quite hard and still going. And then we've got the United States, right? Kim Jong-un no longer influences the United States because Trump's not in power. But United States up to 1%. And look at them. They're all more aggressive than this is us, Jace. This is us down here.
Crikey.
This is us down here. We've just started.
Like, how does the rest of the world fit? Well, there you go. It doesn't, does it? That's the point.
And but this is just a classic example of this kind of BS headlines that come around. I'm going to say it again because when I read this, I was furious. Martin Place risks destroying economic prosperity with some of the most aggressive rate increases in the world. Based on forecasts, not worth the paper that they're written on. Now, whether that second part, I'm neither here nor there. I've got a few opinions of my own on that, and mine I think are smothered with a little bit more fact. But anyway, so ladies and gentlemen, another example about just be careful what you read because it's mostly BS. So we've added another list of persons. So who not to trust, Jason? Well, number one is politicians. Like they're always there. Especially this bloke over here, Jeepers Creepers. Famous economists are at our number two list of who not to trust. Quick bit of trivia for you, Jace. What do all of these people have in common? These famous economists.
I don't know. They got it wrong and still kept their jobs. Is that
they almost never got it right, but they all kept their jobs.
Oh, that's it. Yeah.
We've got now the Federal Reserves of the world, so don't trust the central banks because they can change their mind like the wind. And we've got journalists up here, free all journalists. I reckon you should lock the bastards back up, personally. That's just on my opinion, because here's the reality behind it. And I know I'm making a bit of light behind it, but people are scared based on this. We've had clients who are going, oh, well, we should bunker down. We should bunker down. The world's ending. And
we've had 2 years of bombardment of, lots of uncertainty. And now we get this rhetoric. It is, we've had clients, some of my clients who've said, oh, we're going to sell everything, which is absolute lunacy. They've done well, and thankfully we're able to sort of cut that thinking off at the pass. But, a respected, if we were to say, all right, list the newspapers, list the media organizations that, from absolute trash, almost like a magazine, not a newspaper, to, respected authorities. And you'd go, and I used to say, listen, Fin Review was great. I loved it.
Me too.
Mate. Oh. It's very sad. Yep.
I'm glad I went to month by month subscription with them because it's, and you know why? Here's my opinion, right? It's based on no fact whatsoever, but I reckon this is what's happening. I reckon they're losing the clickbait battle. And so what happens? You can't beat them, join them. So then you start creating sensationalistic shit. And I think it was a few wine and wisdoms ago where, I made the comment that it's astounding how many opinion articles that we're now seeing in the Fin Review and across the board. And it doesn't help journalism. Not one that, and here's the thing: is it doesn't help you because you will look as human beings, we will look for confirmation bias. So if you've made a big investment decision and this happens and you're not confident with investing, then you're probably going to be looking for reasons why not to, right? Because you haven't done it previously. So you're going to be looking for reasons why not to. And you're going to find tens of thousands of them when you go into the markets, into the newspapers. And the problem is you've really got to balance this out. And I got plenty of stuff which we'll go into later on interest rates and where they're going, what it means for markets and the things that people should be looking for. But you've got to be really, really careful about what you digest. And now I'm down to Bloomberg, mate. I don't have too many other sources that I trust these days.
Well, mate, you and me both, and you and I like to do some more research based on data from the source, to be honest, and create our own understanding of what that data might mean to us, right? As investors, as business owners, as whatever we're going to be doing, because if it's seen through the lens of, let's say, a media outlet that is trying to get the attention of the mass population to then end up with readers and subscribers, it's going to come with their bent, their version, their tint on it. And certainly, the person who writes the real estate articles at the Fin Review, I know where she actually started, and she's certainly not.
Just be careful. Let's not get sued here, Jason.
No. The background of somebody is in an industry, but not with experience when it comes to actually being an investor, right? So, if you're going to take investment advice, well, check out what that person is actually giving you advice on.
Yes.
Is it on legislation? Because that's not an investment advice. Is it on the actual outcome or the investment or the behavior, whatever it is? So it's a really interesting conversation to have.
It's so interesting, isn't it? Because I think that almost when you have that sort of media attention, it should almost be Mr. Joyce, $15 million worth of investment assets, $4.2 million in superannuation, and then his opinion piece underneath it. So at least there's some collateral behind it. But I think that a lot of the times, and this is my opinion, is that it's Joe Blogs, $15 in the bank, trying to find how to pay the credit card down, and has a lot to say about investing.
Mate, and you're dead right, because at the end of the day, you have to put you're meant to put your, I don't know, whatever it is, professor, diploma in, advanced, degree in whatever, all of those sorts of things. So it's a really interesting conversation, which I think is important for most of us. And I think a lot of the younger people, Andy, to be honest, have shied away from the mainstream media and are out in kind of the Wild West when it comes to the quality of
dots.
Yeah,
they're joining dots.
they're collecting dots, not joining dots.
Collecting dots and then joining a few of them together sometimes.
Yeah. So, mate, no, that's great, and really, like, folks, for all of us, we got to keep an eye on things, what's going on. Let me do a little kickoff for on my neck of the woods. Let me put myself down there. I think if we get you in there, Andy. Let's see. Up the other way. I'll put myself at the top. There we go.
To the top of you. There you go.
What's in the news when it comes to the world of real estate? Here's what's going on. I could put 25 different headlines and articles out and about. Australian prices have declined for the first, and second month in a row. Andy, you and I have chatted about this. I see the tracking of real estate prices declining or increasing and I'll just say it, a stupid and pointless metric. Real estate is not a fast vehicle. It certainly doesn't translate into monthly or daily transaction volumes and like the share market can. It really does not. If the property market's slowing down, well, less properties go to market. If the interest rates go up, then less people would sell it anyway. Like, none of it makes sense in this way. So, folks, again, tracking property prices and things on a monthly occurrence is actually it's not the same information to analyze as it comes to the share market. The volume's not there. The behavior is vastly different.
Well, let's ask the question, Jace. What and this is what time, so put this in the chat if you know the answer to this. What timeline do you think shares and property are valued on? What timeline do you think shares and property are valued on? Do you think they're valued on 1 year into the future? Because ultimately buying something now means that you expect it to go up or down in value. So the valuation, what do you think the driver is? Do you think it's 1 year? Do you think it's 90 days in the share market? Do you think it's the week? Do you think it's the headline? Do you think it's 5 years? Do you think it's 10 years? Do you think it's 20 years? I'd be interested to know what you think. And if you think it's different for property and shares, right? 10 years or whatever, right? Shares 5 minutes. Or I'd be interested to know what everyone's thoughts are on it. Get busy typing. Give us some feedback. Let us know what timeline do you think.
Well, let me let me try and maybe interpret what you're asking, Andy, because I think I know what you're asking. If you were to buy a property, what expectation of capital increase time frame would you think? And then share prices, what expectation of performance for a share price? Is that what you're asking? Like, so what's the market expect movements for shares, and what's the market expect movement for property? Yeah.
Yeah,
Yep.
basically,
Cool.
when you're buying something, what's the valuation driven
Yep.
by?
Yep.
And it's one of the factors is time.
We've got someone saying here 10-year bond rates. That's interesting. I'm sure Andy might have something on that a bit later. There we go. 15 years. Like I like that one for property for me. 10 years. That's not bad, Jeff. That's yep. Bob saying 1 year, maybe 1 year on shares, Andy. Like, okay, I'm expecting a 20% rise in my shares over 1 year, etc. Jeanette's going 10 years. So
Okay,
certainly.
there's some long term in there. We won't answer it right now. We'll let a few more of you chime in, but we'll answer it in the next 10 or 15 minutes when we get
Hey,
into what you should
yeah,
know.
don't go away, folks. We'll tell you the answer just before the end of the show, so you stay for the whole show. I love it. And we got here property cycle 10 years. You can trade in 24 hours. Allison sort of says, which is true. I think you can trade in like a really, short period of time. We got some people saying, hey, it doesn't property double in value every 12 years. Marcus, it's about a 13 to 15 year cycle historically. So that has been the case. A lot of people have, a lot of people said every 7 to 10 years, which is complete rubbish. We've got a few people saying, okay, Julie's taking a 5-year outlook on property. Okay.
Isn't this interesting? This is great feedback. This is really, really interesting.
Yep. So there you go. Well, listen, folks, don't look at the property house price in Australia on a monthly basis. It's dumb. It's stupid. And to be honest, who cares if it, on average didn't go up this month? In the last bloody 24 months, it's gone up 37%. Like, there was $1.1 trillion worth of real estate value added to the property market. $1 trillion. Yep. Added to the property market in the last 6 months of 2021. So, if a couple of bucks comes off the heat of that, as the markets often overprice themselves, overvalue because of momentum and the FOMO of missing out, and they find a little bit of sensibility, that's not going to end the world. And then there's this talk about interest rates, Andy. Right now, variable, interest only, fixed, whatever it might be. We're on our way to most likely between 4 and 5% interest rates for residential real estate. And what does that mean for us in the world of residential real estate? I'm sure Andy's got a few slides he's going to show a little bit later on, because I did get a sneak peek of a few of them a bit earlier on when it comes to the world of real estate. So that's what's in the news, mate. I've got a few other things you should know for a bit later on, but what do you got in the wings right now?
Well, mate, it's all interest rates as we talked about, and the only interest rate that everyone's talking about right now is the Reserve Bank cash rate.
Yep.
So let's have a little bit of a conversation about the Reserve Bank cash rate and why it is not necessarily the rate that you want to be using as predictive measures.
Because people get a bit sort of like, well, often if we don't know what's going on, we think it's our home loan. That might kick on, but, the Reserve Bank cash rate is not our home loan rate, which is good.
Yeah. Well, here's the thing: is that who should we not trust, Jason?
Nobody. We should trust nobody. The politicians,
journalists,
yep,
economists, and central banks.
The central bank.
We've learned that. We don't.
We can make a model on that, Andy. I actually think we're onto something.
Mate, we're there. We just need one more Muppet to join it, and then we've got the 5. We've got and there's a reason why I say that tongue in cheek. We've got to listen to them. But The reality is they've got an incredible track record of getting it wrong.
Yeah.
And
Yeah.
overreacting, acting too late or acting too soon, and overreacting. And it's a hard science. So I sort of say tongue in cheek, it's a hard job. I wouldn't want it.
No, fuck no, I wouldn't want it either. Jesus.
I reckon you'd do it better, to be fair, though, Jason.
Well, I reckon we would, especially after a wine or two.
But so the cash rate. So here's a question, and if anybody knows, there's a oh geez, I'll give a 60-minute discovery session with me on this one if you get this one right.
Well, quick, get on this, folks. Get on this.
What's the difference between the cash rate and all of the other interest rate measures? What's the one key difference between the cash rate and all of the other interest rate measures like 90-day bank bill, treasury, 10 years, 5 years, all of that sort of stuff? You got about 3 more seconds to type it in. Otherwise, we're done. Because I want to get on and want to tell you.
Get on with it. Tell us, Andy. Tell us, Andy.
It's the only one that is set. It's the only one that is set by someone.
Say that again. Okay.
It's the only rate that is set by someone. So somebody can come in and not influence even. Somebody comes in and goes, all right, we're raising the cash rate.
Got you. So it's the only one that a human sets.
Correct. Right. Now, there are other interest rates in the world where people do, but I went to the 10-year bond. I went for the 5-year bonds. And so I was being quite specific about what I was saying.
So they're a knock-on effect.
Right. So this is the only one that is set. And it's set by people who have got an incredible history of overreacting, underreacting, and getting it wrong.
Well, when you say it that way.
So it makes no sense to react so aggressively to it. Right. So this is the Reserve Bank trying to react against inflation going up. And let's face it, Jace, there is a huge amount of inflation that is transitory right now, which is food, which is energy. And some of these decisions that have been very difficult for the Reserve Bank to make have been made based on COVID and then, right? COVID and then Ukraine, right? And now that's a bit of a double whammy, right? But when I say transitory, I mean cost increase in energy, in wheat, in food, short-term increases. So where do you look if you are an investor that wants to kind of go, well, shit, okay, short-term interest rates are rising and that's going to hit my pocket now, but that's not the question you should be asking yourself. You should be planning for what's happening in 12 months' time, what's happening in 3 years' time, what's happening in 5 years' time. Because let's face it, if you've bought an investment property right now and a 1% interest rate rise means that you have to sell and you're going to lose your shorts, then you probably shouldn't have bought the property. And I think you'll probably agree with me on that.
Shouldn't have bought it in the first place. And I'm going to show something in a minute that shows that most people, I've got, good. I like that, Andy. You shouldn't have bought it in the first place. I don't even know how you did buy it in the first place. But let's get
now.
To
the same thing goes to stocks, right?
Yep.
The same thing goes to stocks. And remember, I asked the question about how long. When you value something today, what's your measure of value on that? Because you're going over a period of time, I want to make some money on this. So my question to you is, over what period of time, how much money do you want to make? Right? That's the question.
Well, it's an interesting one, because Alison here said, bought a property, went up, based on, an online desktop valuation, at a period of time, goes from 990 to 850, and it's almost like, again, it's kind of like it's an individual answer, Andy.
It is, but how they're priced is very consistent.
Yes.
And they're priced off longer periods. So let's have a look at, this is the 90-day bank bill rate is what businesses quite often operate on. And I'm not going to get into the technical side of this because you can see here how this yield, right? So this is 90-day money. If you want to invest money in 90 days at very, very high security, this is where you go to do it. And you can see that it dropped and then it just flattened out. Now, I'm not going to go into the reasons why because it's quite complicated, but it's called quantitative easing. It's called manipulation by the Reserve Bank and the government effectively to keep the prices low in this market. So the first one, market.
It's artificial, right, Andy? It's like an artificial. Yep. It's not market forces. It's like artificial. We're going to, either stop something or increase
Well,
something.
if you want to sell more stuff into the market, Jace, what generally happens? Right? Like if you flood the market with something, well, people will generally pay less for it.
Pay less for it. Yep.
Right. So, or on the opposite side, if you're trying to borrow more money in the market, then people are going to go, you're getting more and more risky. Right. So the interest rate should go up. But if you're buying back bonds, which is what the government, the Reserve Bank have been doing for a long period of time, if you're buying those bonds back, it suppresses the interest rate for the government to then lend money still at a lower rate. I'm not going to go into any more of that because it'll blow people's heads up. But
right, so we'll just do a little quick answer to a question we asked before. Deb Jensen, our absolute legend here. Deb, can you be our producer? You know,
I still don't get it, Jace. Were we right or wrong? Like,
well,
don't answer the question with a question.
Total guess, and I think I was right. So a result is for effect, and affect is for an action. Thanks, Deb. You're a legend.
Learning on the spot.
Yep.
So this is, but the 90-day bank bill is how companies quite often have debt, right? But so your business, Jace, if you wanted to go out and borrow money at a commercial rate, it's quite often 90-day bank bill rate plus a percentage based on your risk margin.
Any commercial loan is based on a 90-bill bank rate. Yep.
Right. So it's been suppressed and now it's launched. But are we investing for 90 days, Jace?
No, we aren't.
No. So we were talking about this going on for a little while. So you can see this suppression happening here, right? But this is now the 3-year government bond rate. And the 3-year government bond rate is set by market forces, which basically means it's the market intuiting where the future is going to be in 3 years' time. And it's pricing in the expectations. And what we can see here, and there's multiple reasons for this price increase, and this is 4% just over here, right? So this is saying that in 3 years' time, they believe that interest rates are going to be just short of 4%, or the cash rate's going to be just short of 4%, right? But look at where it's gone now. It's actually dropped. Now, there's a fair bit of volatility in that, but that's a reasonable drop that's happened. And my belief on this is that we're seeing that there's the transitory inflation of Ukraine, oil, power, food, these sorts of things are now starting to normalize a little bit. And in 3 years' time, there's a belief that COVID, mobilization of ports, shipping channels, all of these things are going to normalize. And in 3 years' time, potentially the reason why things are more expensive isn't because of the fact that you can't get it and there's lots of people wanting it, right? It'll probably normalize because all of a sudden, commerce will start to happen properly. Ships will start traveling without having to worry about COVID and being stopped and all of these sorts of things. So trade will normalize, and then all of a sudden that inflationary aspect decreases.
Yeah.
Right? Because normally the world inflation is based off demand-based inflation. Right?
True underlying demand. Yeah.
Yeah, because there's a lot of demand. This time it's actually the supply has been choked or stopped. And so we can't get it. And the Reserve Bank
demand really hasn't grown like long term or like, maybe short term issues. But yeah, the demand hasn't grown, but the supply has shrunk. Yeah.
And stopped.
Yeah.
Yeah. In some cases, literally stopped.
And so do you think that sort of market pricing and kind of like, that aggressive kind of going towards 4%, the market saying, hey, if something doesn't get sorted soon, the delay would mean it'd have to be more aggressive interest rate rises if the action was delayed. So if the RBA said, oh, you know what, we'll wait another 6 months to see what happened, you think the market would keep pricing it because they know the kind of the parameters, I don't know if they're parameters that you'd have to kind of overdo to bring it under control?
Well, growth stocks and things that we'd consider to be growth assets would continue to skyrocket. Yeah.
Yeah. Yeah.
Right.
Yeah.
But the reality is the Reserve Bank is targeting inflation, which is not stock prices, right? It is more housing prices and then the price of milk and the price of petrol. But the reason why the price of milk and petrol are higher isn't because of normal market forces. It's because of supply chain disruptions. So raising interest rates doesn't actually help people stop buying petrol. It doesn't. It causes pain for people who have to buy the petrol and have to buy the milk.
And
And this
arguably, arguably, the bloody government is to blame for the property price sharpness in the last 2 years anyway,
let's not
because
even
of the
jump into that.
overstimulation of. I mean, I'm a property guy, but I'm thinking, stop throwing money at my marketplace. You're ruining the actual normalcy of it. Like, piss
right.
off.
Taste but don't touch.
Yeah.
You know, it's they go, well, we want to stop the property market from becoming unaffordable, and then they go, well, here's some more money to go and buy property. It's like, hang on, like. Anyway, that's a whole different bloody argument there, right?
Given away $60,000 of free cash per property purchaser. Like, tell me that doesn't then just artificially blow the market up. Anyway,
we want to make property more affordable for your average person, so we're going to subsidize it so everyone can buy property at a higher value. Like, what? What?
Yeah. Anyway,
mate,
no.
That's one of the reasons why we don't trust politicians. So our 3-year government bond rate is dropping. And here's the thing, our 5 and 10-year government bonds are all dropping as well. Right? So what this means is that the market is generally a lot smarter than any individual, right? The market tends to overreact, right? But and that's fine, right? It overreacts in the now based on 10 years into the future. So the answer, so those of you who said that shares are basically priced on the expectation of 10 years into the future, because what they're doing is they're going, you're going to pay now, today, right? Today, what are you willing to pay for a piece of property, land, a share? Given the fact that you're going to hold that over the next 10 years, and the rate, if you just stuck it in a government bond, in 10 years' time is going to be, or in 3 to 10 years' time is going to be 4%. Right? So if you buy the property for too much, right? It means, so paying too much for that property, it means you're paying above and beyond what we call the discount rate. So you can invest. Now, you can go out and invest for 10 years and you can get a 3.5% 10-year guaranteed rate of return, right? So if you can get that now, that means that, potentially that property or that share that you were going to buy yesterday, you're going to want that to give you a higher level of performance based on if interest rates are at 0. Does that make sense?
Yeah, well, I mean, is it part of like, okay, the performance that I need is, the 10-year bond rate plus a minimum of inflation? We've talked about that before with our folks. It's like, inflation kind of average, 20 years, 3.5%. You want to price that into your overall return to just make sure you're staying at least, 2, 4, 5% above inflation plus some other benefits, So, is that what you're trying to say there? Is like, okay, the bond rate, you've got to be beating it, or why would you risk it?
Well, let me ask this let's answer a question with a question. So if I could invest money right now, $1 million at the government bond rate at 10% per annum, would you invest in any of the properties on the market right now based on current valuations, or would you put the money in the 10-year bond?
Well, if I had cash, then, 10-year bond. If you had significant cash, it'd be a no-brainer.
Well, yeah, you would every day of the week, right? But if that rate is at 0.3%, where are you going to invest your money? Are you going to invest that $1 million in property, or are you going to invest it in bonds?
Well, at the end of the day, even cash. So you got to have enough cash to buy a piece of real estate. So it's got to be $1 million. So the idea would be far better in real estate than it would be in bonds at that point.
So
if you don't include leverage.
What's better, even without leverage? What's changed? The only thing that's changed is the interest rate on the 10-year bond. And so if the interest rate is 1%,
I think I'm with Alison. We should put 10K into wine. Andy.
Well, funny you should say that. The Fenton Wine Fund coming soon.
FWF.
Yeah, FWF. But anyway, long story short is that if interest rates were going to keep going up in perpetuity, if we expected that the 10-year bond rate in 10 years' time, we're going to be borrowing money at 20%, right? The world would be a very different place right now, right? As in property prices would be falling dramatically, shares would be falling dramatically, because in 10 years' time, you could literally start to put money into bonds and get a 10% yield if that's what they were doing, 10%. But what they're saying is that no, the market expectations are not that interest rates are going to keep rising. Well, at the moment, they've come back. Now we need to wait and see a little bit over the next, 3, 4, 5, 6 months and see how this yield curve sorts itself out. But ultimately, what the interest rate markets and the markets that are not set or influenced, the markets that are determined by market forces, which is just the economy rolling on, are saying that that at the moment interest rates are coming back down, and that cash rate is looking at around about in 10 years' time, let's say 3.5%. So if we just for a moment accept that this is potentially true, I know I've got so much more. We'll just say let's accept that this is maybe true. How would you as a share investor, or how would you as a property investor start to think differently about the future? Would you start going, the world is ending, we've got to sell? Or would you start to go, okay, there's potential opportunities in there. There's, rent rises. There's share markets operate very, very quickly based on this sort of information. They overreact as well, and they provide incredible opportunities to get back in. But if all of a sudden we're going, well, the market is believing in 10 years' time the interest rate's going to be, 3.5%, not 10, not 20, not 18, not what it was back in the days of Doc Whitlam. It's expecting that it will normalize to some sort of reasonable effect. So how would you invest now? And I think that's what people need to be asking themselves. Okay, interest rates are rising. Yes, they are. And yes, they will. And it likely, it'll be in and around that sort of 3% cash rate, which would translate, one would think, to around about a 5% mortgage rate or somewhere in around there. Now, whether it's 6
it's
or
usually
7
a
or
2 to 3% margin on top. Yep.
So how do you position yourself now for that? And this is how we price shares, because we look at the 10-year forecast. Because when we're buying shares, we're not buying shares for 90 days. The fact that you can buy and sell them in 30 seconds doesn't mean that you value them in 30-second increments. You value them based off 10 years. And if 10 years is saying you can lock money at 3.5% for 10 years, well, I'm going to want 2.5 to 3 times that potential return from a company in order to invest in that for 10 years. So if it's 3, I want to see a 3, 6, 9. I want to see a 9% annualized return for that stock. And that's how we price stocks. That's how we price them. And that's how commercial real estate is priced. And I would venture to say that it's pretty close to how normal property prices in residential would be priced over time. Not that that's my game, that's yours, but that's my belief.
Yeah, Resi has an emotional behavior to real estate that breaks that bond to the yield, especially if the real estate is located in places where owner-occupiers will make emotional decisions, and it's not based on a rental return. So that's where the value game in residential has this kind of like it's actually got a two-edged sword to it. If you can walk that thin line well, you can actually play the best of both worlds, Andy. So, and folks listening in, commercial, absolutely. If you have to borrow, if your money is going to cost you more, then and your return is eroded, your value is eroded. End of damn story. However, in the world of residential, if your money is going to cost you more, but your location of your real estate is in a place where they're not building them anymore, or it's really in demand, the value disconnects from its ability to create a yield because it's desired by an owner occupier. And we all know, folks, I've been guilty. I'm sure Andy has too, of something you fall in love with, you pay more than you should for, because you want to bloody live there and bring your kids up, and it's the school zone and all this other stuff that has nothing to do with an income, nothing to do with future value,
But that's
nothing
a
to do with a
choice.
tax return. Yeah.
And this is what I say to a lot of my clients, and they go, Andy, should we do this or should we do that? And you go, that's the only question I'm not going to answer, because
Yep.
that's lifestyle. That's not investing. That's
That's it.
investing in your life, right?
Yeah.
And it's kind of, but I can't determine the value of that. And I know it, as much as you do, as much as the next person, is because I want to live where I want to live for the little bub coming a long way, and so there are certain sacrifices I'll make from an investment perspective in order to do that, and that's a personal decision. Because otherwise, if it was all about investing all the time, you'd probably never own a principal place of residence unless you were a builder.
No. Well, you and I know there's a few good reasons to own one. PPR upgrade, capital gains tax free. We talk to people about that strategy all the time. Folks, if you don't have a few strategies going on, you need to reach out to me and Andy. I know most of you I've seen in the chat tonight are part of our program and our coaching. But if you are not, you need to be, because there's 4 or 5 strategies you need to have in play at all times. 100%. We did have a couple of questions, Andy.
And when the world is shitting itself, that's where all of the opportunity sits.
100%.
And I'm not saying it's right now, but when people are cacking themselves and building bunkers, when that sort of stuff's happening, go, oh, that's interesting. And then start to look for what is the reality, and don't follow the herd. Listen to the herd from the perspective of going, oh, that's interesting. That's where the herd's going. But now is going to be a very, very interesting period of time where people are going to make some very interesting decisions. And hopefully, don't buy the bunker. If you have to buy the bunker, the reality is, Jace, that we're all pretty much fucked. So we'll all be in the bunker together.
Well, I say don't buy the bunker, buy some land. Here's a little story, folks. It's an interesting story. I didn't get a chance to tell you this one, Andy. Me and a few people bought a property, a developable property, 6 months ago for $3 million. And we just got our valuation back today, folks, in the middle of interest rate rises, in the middle of it all, in the middle of the world ending. Tell me, we can get 38 townhouses on this piece of land, Andy. We've got it approved. Tell me, folks, has our value gone down in the middle of the world ending? Got our valuation back today. What do you reckon? Give us a guess at what our valuation came in at today. $3 million we bought it for.
Well, mate, I'm going to throw a couple over the fence at you, because I've just been a part of a few deals that have been quite staggering, and I'm going to say,
look at Jeanette. Look at Jeanette nail it. Good work, Jeanette. It came back at 4.4, so pretty close. Jeez, Bob, Bob, I think I want you to be my valuer.
Well, mate, I've got one at the moment that's 8. That's been valued at 8.
It came back at 4.5. What did I say for Jeanette? Yeah, 4.5. Yeah, there you go.
There you go.
4.5, Jeanette. You nailed it. Have you been looking at my text messages, Jeanette?
So how's this one? Now this is an outlier,
and yes, it is Albany Creek. You're in there. Nice work,
real
Dan.
live scenario. 8.6, commercially valued. 8.6. What do you reckon the value is? Literally buyer right now.
I need some more info, Andy. Commercial property.
I can't give you any more. But in the middle of interest rate rises, 15. Yeah. 8.6 was the val, 15 was the offer, 20 is the ask, is where it will be sold.
Wow. Must be some upside, some other upside there in there that's hidden.
Well, and there is. So this is, this property has been held for 15 years.
Yeah. Yeah.
It's been a dog for 15 years, Jason.
It changes overnight.
And imagine if you'd sold that like 3 years ago for maybe a couple of $100,000 more than what you bought it for.
Every single property, folks, listen to me. Every single property in Australian history, if you own it for 30 years, has 5 to 6 times where there's something weird that happens that affects the price for some weird reason in a short period of time. And so many people, Andy, like bug out. And it's the same for the share market too, I'm sure. You own
It
shares
happens
with,
faster,
yeah,
and people
yeah.
freak out because the movements. Like, the reality is, Jace, I reckon that in the depths of different markets, if people could sell properties and transact them as fast as what they can shares, I reckon you'd see the same volatility
I
in
reckon you would.
property market.
Yeah, that's why I'm thankful that you can't. But
Yeah.
Come soon enough into the future with world technology, but hopefully in the next 10 years anyway.
Well, mate, our top 2 performing funds, one's a private equity. Oh, they're not the best performing funds, but geez, they're bloody consistent. 2 of them, they cap redemptions. They mean when the market shits themselves, you can't take your money out.
Mate, that's the way it
And
should be.
it's built in, and it's built into the constitution of the investment. And even I had the itch to sell some of it because some of it was in the commercial property space, in office space, in CBDs. It went up by 24% during the middle of COVID when people were getting out of leases left, right, and center. So the ability for people to sometimes stop you from doing stupid shit when you're emotional means that these 3 funds, all of them, I had people have redemption requests on them. They wanted to build the bunker. They wanted to get out. They wanted to just jump ship. 12% annualized over 10 years, every single year. 21% in the last 12 months and 11.5% over 10 years per annum. And and 10% annualized, and it did an 11.5, and they stopped you from being able to redeem the funds so that they can hold the investments through volatile times. But in the share market, in the stock market, that doesn't happen. You want to sell BHP, you can sell it like that.
It's out.
And
Yeah. Well, it's reflective of the noise and the fear, really, not the foundation, really, isn't it? And that's where, I mean, Andy, that's what you say. That's where opportunity lies sometimes, in
great opportunity.
buying. Yep.
Absolutely. I've got a number of clients that have recently, and I love it when this happens. They've been emailing and ringing up and going, should I put more in? The market just completely shit itself. And I'm like, that's such a great way of thinking.
Good question. Yeah.
It's such a great way of thinking because it's like when other people are freaking out, you're going, okay, where's the opportunity?
Where's the opportunity? Well, there was a couple of questions. I did want to get around to answering one of them. I think before maybe we call it done and dusted, Andy. Because we haven't done this for a fair few weeks, folks. I reckon I could sit here for another bloody 2 hours with you, brother. But Lindsay, to build or not to build? Good question. Certainly depends on where you are right now. And I did a little Wealth Coffee chat this morning on this one, Andy. But right now, we are seeing, let me quickly share my screen here, and I'm going to hopefully, turn that on. There we go. Let's put us, there we go. So check this out. I did a bit of a Wealth Coffee chat on this one this morning. Lindsay says, hey, to build or not to build? Good question. We have had a significant increase in the number of individual houses being built, folks. Right? The number of individual houses being built. Not an increase in residential underlying medium density projects, ladies and gents. As you go. Oh, hey, Zara. Good to see you. Good to see Maddie. Marie. Magic Marie. Money Penny in the house. Great to see you guys. Thanks for joining. Fenton just ran off because I don't know what he's doing. But anyway, I'll continue the show. But we have seen a significant increase in one-off standalone houses. Okay. We've seen that. Now, that is traveling through the marketplace, Andy. So this started, the peak of that was middle of sort of end of 2020, early 2021. Okay. This supply is owner occupiers only, folks. Owner occupiers only. It's what I call fake supply to the residential rental market. It's fake supply. It's taking one person out of a share home that 4 people were in, and one person now gets to live in their own home. It's not making a dent in the marketplace, and we're seeing the tail of that approval and construction start occur right now. So, Andy, and to answer Lindsay's question, to build or not to build, right now, Lindsay, if you could delay it another 6 months, I would, because my call right now is in 6 months' time, you're going to see tradies shopping around for work. In this space, Andy, in this space, this residential one-off real estate space, over 3-story construction, so high rises and stuff like that has been like very little affected for tradies, but it's been affected for materials. Okay, so because tradies have to specialize in that type of construction. And you need special licenses and stuff like that. So kind of, I'm not answering it perfectly, Lindsay, but if you're building something residential, I'd sort of kick it down the road for 6 months if you could right now. And I reckon you'll get a better price a bit later on. Or you might not necessarily get a better price, but it'll get built in 16 weeks, not, 52 weeks.
And it goes down to contract terms as well. Is that no builders don't know where to put their contracts at the moment.
They don't know.
Mostly because realistically, the prices in them, they can blow it out their ass now because there's been so much variation in supply chains and the cost of materials behind the scenes, which has got nothing to do with the builders. Let's face it. But also then labor force. Supply chain, a lot of this needs to normalize before you're going to be able to see through it clearly.
Yeah.
So there's the potential that you will be able to nut it sweet and really, have incredible results. But that's going to be, I think, it's not going to be the norm, because here's the reality is that things are still more expensive in order to get here. Timber is still in shortages, and labor, we're still getting our way around it. Yep. And there's comments coming through that labor is the main issue. But the reason why a lot of construction is getting so difficult to price is because the supply chain is starting to normalize, right? But it's not necessarily come back down. And so the cost of materials has now stabilized, but when and if there is a chance that supply chains normalize, whether there is more material than is needed, that's the only thing that's then going to push the construction costs down from a materials perspective.
Yeah.
And we're only going to see that as supply chains start to normalize a little bit more. And we're seeing that. And if we go back to the 10-year government bond yields and the 5-year government bond yields, that is a predictive measure that this transitory supply chain issues are going to start to work their way through the system.
Yep. And we're seeing right now, like, this construction issue working its way through the system.
Yep.
And unfortunately, like, everyone thinking that there'll be constraints on supply of land for the foreseeable future. Well, that is true. There's going to be constraints on land, Andy. There's not going to be 100,000 houses to build this year, folks. Right now, like, those builders who are building 100,000 houses from a year and a half ago, there's 35,000 houses, Andy, right now in approval. So the labor shortage will, in certain circumstances, work out a little bit. The supply chain stuff, well, that has to flow through. There's plenty of other things that have got to work out. But if Lindsay's saying, hey, listen, should I build now? I would say, Lindsay, kick it down the road a little bit. You don't have to wait too long, because I think you'll get a little bit sharper and a little bit clearer in under 6 months' time, personally. But for those who are building right now, I'm building right now, folks. Like I'm building a friggin', 6-bedroom mansion up in bloody Brisbane for someone to live in right now. That price has gone up $76,000 for me. I'm in. I can't stop. I've got plenty of upside. I'm not complaining about the marketplace.
Well, they're bumps in the road, and I think that the thing is that you do need a long-term vision. And if you're of the mind that the world is over and we need to build bunkers, well, just don't fucking invest. Just pull the plug, get out. It's going to cause you too much stress.
100%.
If you're a proper investor, which is going, I'm buying for the next 10, 15, 20 years in order to build wealth, well, this stuff actually just becomes noise in the background. And disciplined ways of going about investing in business, and probably the best way to look at it is to ask you the question back, Lindsay. Given where you sit and what costs you have in the business right now, and the amount of labor that you have right now, would you choose to take on that sort of growth project within the business right now? And if the answer is yes, then it's probably going to be because you've got a long-term outlook that says that, the benefit is going to be there. And so the answer may well, like if it's pure economic, could you do it better in the future? Then you possibly could. But if there's other opportunities around for you right now that mean that in 10 or 15 years, it's going to be irrelevant.
Yep.
Then maybe the answer is build. It really just depends on what your time frame, what your outlook is.
Well, and that's part of, what we have done with our project. A few people have been involved in just recently, the townhouses up in Brisbane. We've extended that, almost 9 months from when we were initially going to kick it off. And we're already seeing, for the first time in over 18 months, Andy, the cost of concrete, so putting a slab down on a house. So this is kind of the first thing that happens on a house, actually come back 5%, right? So boom,
I'm about to put down a slab, Jason.
Mate. And so we've already got from some of our builders, 3 builders have already told us they're getting callbacks from concreters for the first time in 18 months. Hey, you got any work on? So these are the kind of the early signs of, hey, within the next 6 to 12 months, that labor shortage, because of that stimulatory free money given away across the country, will be gone, folks. That'll be gone, and we'll be back to what's called the market normal delivery. And are we in an excess of things to be built, like one-off freestanding houses? And the answer is no. We're in a disastrous low, Andy. And then labor will need to work out what it does with that, right? And I think the cost of labor will come down a little bit. Materials, I don't know. I don't think materials will change that fast, but yep. Bob's saying, I haven't had a plumber get back to me after 1 year. I'm trying to get a small job done.
That's been the same for about the last 20 years, to be fair.
But there you go. That's what's coming through, folks. That's where we. I've got another 20 things to talk about, folks. We run out of time tonight, but we'll have to do version 2 of this one, as we kick back off, folks, as we go. So, Andy, I think we'll put a pin in it, brother. Wealth Coffee Chat. No. Wealth, Wine and Wisdom. Done. I better put some more wine in my glass, actually.
Right, you'd better. So just remember, folks, I'm doing Jason's part here. It's a marathon, not a sprint.
Mate,
good to see you, mate.
Good to see you, brother. Good to have you and the rest of these fine folks on for another Wealth, Wine and Wisdom, and best content yet. Thanks, Jeanette. Love it. All right. Well, it's good. It's good. Good to see us back. Well, thanks, folks. Appreciate you guys joining us. we will be consistent now from here on in. We do have some gears to change coming soon, folks. We've got a couple of exciting things. Andy and I are launching a series in Wealth Wine and Wisdom called The Exit Plan. And it's going to be focused on business owners, but not excluding others. We've got some cool things that we've been developing in the background, but certainly it'll include anyone who's interested in investing. But stay tuned to that one. In the next couple of months, we're launching that series as well. So, mate, great to see you. Good to hang out with you. Thanks, folks, for joining us. And, well, I think it's a good night from him.
And it's a good night from me. Good night, everyone.
Cheers, folks. Have a good weekend. Bye-bye.